Days to expiration versus implied volatility. Days to expiration versus implied volatility. Let's take a look and see what we got. So recently we did a study on a segment that demonstrated how time and volatility have a significant impact on option pricing. And we know that we can adjust trade duration based on different volatility levels. If volatility is high, we can reduce duration. If volatility is low, we can increase duration. We've done multiple studies on this showing that when volatility is really low, like it is now, if you increase duration a little bit and go from like 45 to 65 days, you synthetically are, giving yourself a slightly higher volatility, right?
That's exactly right, because time and volatility are synthetic equivalents to each other.
So we decided to go into details with different days to expiration and implied volatilities to give more clarifications, because this was a request from many viewers. And the request comes in the form of, hey, vol's low right now in a lot of stocks that I want to trade. If I go longer, how much longer should I go to essentially make it something where I'm not taking, where I have a reasonable risk reward? I'm trying to just give myself, I want to trade this one underlying, hasn't had high volatility in so long. I just trying to figure out how to do it with the highest, how to optimize my position as best I can. Okay, that's it. Yeah, it's a totally fair question. So 19 years of study, 16 delta strangles. We used only the SPY for this. We compared selling 7, 14, 21, 30, 45, and 60 days. Okay, we went all the way out just to show you, because it gives us kind of the biggest range, looking at 6 different time frames, and just so you can see how this works. And obviously you can expand that and just interpolate and take it out to 75 days, 90 days, 120 days, whatever you want. We calculated the win rate, the standard deviation, and the ratio, the percent ratio of CVAR over buying power. We held to expiration and compared to managing at 50% of our max profit. Okay, so basic concepts. In theory, if we reduce volatility, we can increase duration to account for the difference. But how does it play out in a real life example? So in this study, we focused on incorporating the mitigating risks, determining the required capital, the buying power required, analyzing the days to expiration and implied volatility, identifying the optimal strategies. Lots to unpack here. This table presents the outcomes for various implied volatility levels when compared to days to expiration, ranging from 7 to 60 days, and assuming that the positions are held to expiration. So when I look at this, all right, volatility less than 20 and volatility over 20 to kind of, and right now, obviously we are in a position of volatility less than 20. First thing I notice is the win rate doesn't change much at all. Second thing is that obviously the longer you go out, the standard deviation, I don't know. I can't make a judgment on that. The buying power decreases as time goes out. The real difference here is CVAR as a percent of buying power. I mean, I guess
what this shows me, and I think the critical column here is the win rate. Like Tom just said, it's basically the same. Is 78% different from 75? Of course it's different, but that's not a meaningful difference here. The win rates are in that low to mid 70%, which is our target for these short strangles. I'm happy if I'm getting those win rates. So regardless of whether I choose 7 days or 60, look at the extremes. Less than 20% IV, 7 days, greater than 20%, 60 days. The win rates are basically the same. The difference is the standard deviations. So the standard deviation of returns, in that case, when you go out too far when the volatility is low, is relatively high. So the standard deviation of those returns jumps around quite a bit. And it's hard to come up, for me anyway, to say, this is definitely what you should do. It's either, when it's less than 20, you go out to 30 days, or 60 days. When it's greater than 20, you go out to 30 days. I'm not quite seeing that. But what I am seeing is that lower volatility typically has lower standard deviations, which is what I like to say is volatility doesn't lie. The best predictor of future price changes in SPY in this case tends to be the current implied volatility, right? If it's lower, it tends to predict lower price movements, and that's what you're seeing. You're seeing lower standard deviations when the vol is less than 20 versus higher than 20. And these are standard deviations of the returns. The buying power, and this is a really critical thing. The buying power is basically the same too. This is because we're using buying power calculations that were written in 1935. It is all price based. It only cares what the price of SPY is, not what the volatility of SPY is. They saw price as 90 years ago, they saw price as risk. They didn't know how to calculate, well, I don't think they did. They didn't know how to calculate volatility. They didn't see volatility as risk. So we know better, but in this case, the buying power is basically the same because it's price based. So you can actually get higher CVAR over buying power if you choose a little bit longer when volatility is, look at the CVAR over BP. You have to go out to 45, 60 days to get the higher returns on capital. You get higher returns on capital when IV is over 20% with shorter time frames, 14, 21, 30.
We actually highlighted TP. We actually highlighted the 45 days to expiration because that's kind of our wheelhouse, and that's kind of the strongest numbers.
Benchmark.
That's the strongest numbers. But also, if you go out a little bit longer in the lower implied volatility, it doesn't hurt you. It allows you to kind of extend. It allows you just to pick up optimize the trade ever so slightly. That's all it was.
Right.
This table presents also the outcomes for various IV levels when compared to days to expiration when managed at 50% of max profit. Now remember, the last one was when we held all the way to expiration. But what we're doing here now is we're managing at 50% of max profit. We managed at 21 DT, but whatever, 50% of max profit just was easier for the calculations. Where it outperformed the results when you hold until expiration, the win rates increase, standard deviation decreases, and it reduced the overall risk. So when you look at this slide, when you manage, obviously earlier than holding to expiration, so last slide was holding to expiration, this one becomes much more apparent. And the 45 days and then potentially longer when the implied volatility is under 20, you can see the slight advantages to again, the win rates don't change. The numbers get much better at 45 days and beyond.
That's exactly right. Going back to the whole point of volatility and time are synthetic equivalents. These studies are showing you are trading time for volatility and volatility for time.
Yeah, and when you look at when volatility is over 20, I mean, the numbers are really obvious. When volatility is less than 20, it's not as obvious, but it is. I mean, what Tasty is all about, optimizing your decision making, because we can't pick trades for you. Even if we could, that's not what you want. Like, all we can do is really optimize using our research. We can optimize your mechanics, and hopefully your decision making becomes better. And so in this case, this is again more proof of the waiting a little bit longer, and also the reasons for it, backed up by numbers.
It's using capital efficiently.
Longer DT options allow for higher premium collection, but they come with increased risk, as higher CVAR ratios suggest that premiums may not offset the risk of significant price movements and potential losses, especially during periods of high market volatility. Additionally, slower time decay in longer dates to expiration options extends risk exposure and contributes to a higher CVAR, necessitating stronger risk management strategies like robust hedging and conservative position sizing. Kind of just common sense comments that we added on here. Despite the increase in risk and standard deviation with the longer days to expiration, the buying power decreases and the win rates stay relatively constant. This indicates that profits also increase gradually, more premium. The key is to apply the appropriate risk management techniques effectively and to stay mechanical. However, managing at 50% of max profit or managing positions early, that's 21 DTE, and within 45 days to expirations offers the optimal performance across the board, especially in high implied volatility, but also in lower implied volatility. This was just kind of more evidence and more research to support kind of what we already know. I don't know, TP, it's just another good piece, put it in the back pocket, and it just kind of supports the mechanics that we already use.